And of course, oil prices are pushing higher amid the ongoing geopolitical tensions in the Middle East. But our next guest says the market response to the war in Iran has been relatively subdued for now, and for good reason. Joining me now is Jack Manley, global market strategist at JP Morgan Asset Management. And Jack, thanks very much for joining us. It's been subdued, but it's been a bit of a roller coaster, though.
Yes, it has been. I mean, that's a good way to think about it. There is a lot to unpack when it comes to how we approach this market in the face of conflict in Iran. Geopolitical events typically follow a playbook, so to speak, when it comes to market performance, which is that a geopolitical shock injects uncertainty into the landscape, and uncertainty translates into volatility. Investors brace for kind of the worst case scenario, but at some point, usually sooner rather than later, we realize that all these problems, well, they're happening somewhere else. They're not happening here on our own soil. We kind of go back to focusing in on those domestically oriented fundamentals. The one exception to that rule, though, is when geopolitical shocks impact energy. And that's why what's happening in Iran is so potentially disruptive, right? Iran is itself a fairly large petro state. They have control over quite a bit of the transmission mechanism behind global crude through the Strait of Hormuz. They have the ability to disrupt production in other neighboring Gulf states through attacks. And so as a result of all this, oil prices, as you mentioned earlier, are a little bit higher, and markets have been quite wobbly. At the end of the day, though, I think it is very important to remember that the Western world in general is a whole lot less energy intensive than it used to be. In other words, energy prices matter a whole lot less for economic growth now than they did 10, 15, 20, 30, 40, 50 years ago. You add on top of that the fact that places like the United States are net energy exporters, that countries like the U.S., like Canada, are largely energy independent. It means that energy shocks matter, we'll feel them, but the magnitude of that impact is usually a whole lot less, or it should be a whole lot less than what we've come to expect in the past. Hence, that much more muted response, I would say, all things considered.
Although on a bigger picture, will we not pay? Because even though we're not needing that oil necessarily, the countries that do need the oil are the places we buy things from, like China. And do we not have to worry about inflation with that?
Oil is a global market, and so it does have the ability to filter through into inflation. That inflation can show up directly through the energy bucket that you'll see in, say, a CPI report. It'll flow through indirectly in a number of different ways. You know, maritime shipping costs could increase, airfare could increase, the cost of firing a steel plant could increase. I mean, lots of different ways that it can filter through. Now, that might have moderate implications on discretionary spending, which in turn could push growth maybe modestly lower. But my opinion on this is that it ultimately needs to come back down, not to what's going on with growth, but how it translates into an outlook on interest rates. And frankly, central banks have learned over the last several years, as they should have known for a very long time, that they have no control over supply side shocks. And that is ultimately what we're seeing right now, a supply side shock. So while we may see a little bit more inflation in the U.S. and Canada over the next few months, on top of what was frankly already expected, I don't think it's going to do much to derail the narrative around the interest rate environment. I think the Fed is still likely going to cut once, maybe twice. I think the BOC for now is still keen on being on hold. I don't think conflict and inflation that comes from it challenges that view, which is ultimately what's going to matter most for markets.
All right. And then closer to home, is the bigger issue then for Canada, at least, is it CUSMA? Is it tariffs? Are those the things that could have a bigger impact on this country right now?
I would say yes, if only because they are the wild card, right? I mean, the trade regime really since the start of last year has been wildly unpredictable. It feels like every month there is a new development that changes the calculus on how tariffs are being paid by various global trading partners. Now, my base case for CUSMA renegotiations are a pretty good one. It is in everybody's economic best interest to roll forward a continuation of most of what's made the new CUSMA, the old NAFTA, work so well. And while there's a lot of outward-facing dialogue that may sound discouraging, evidently a lot of the conversations happening behind closed doors are actually quite encouraging, right? This idea that policymakers will let their cooler heads prevail. So it is the risk to the outlook in the sense that it is unknowable, it is unpredictable, it is probably the biggest thing that the Canadian macro story hinges on. But my base case here is a continuation of that existing relationship, more more or less as it is right now, which would be, generally speaking, a positive signal for the Canadian forecast.
You know, we had Donald Trump the last time the negotiations happened. There was lots of talk. We ended up pretty much with the same. This time around, does it feel different with Trump, or no? Or are you thinking those cooler heads can convince him?
It feels different in that things are a lot louder now than they were during the first round of negotiations. But we have to remember that there are appointed trade emissaries here that are actually the ones ultimately having policy conversations. They are typically going to be a little bit more level-headed than what you're getting out of, say, the president. We also have to acknowledge here that Canada and Mexico have done a whole lot of talking. The fact that you have a unified front on the other side of this negotiation is helpful. We also have to talk about the fact that Canada has, I think, a disproportionate amount of influence in a lot of these trade negotiations. You know, American access to Canadian timber, American access to Canadian crude, particularly interesting right now, American access to Canadian uranium, which is critical for fueling the nuclear renaissance that the United States is hoping to embark in to help to power all this new AI capability. Despite the fact that the Canadian economy is roughly 1/10 of the size of the American economy and that most Canadian exports go to the U.S. needs a lot of those exports. And I think Canada will use that as part of their negotiations. And again, hopefully mean that a lot of this blustering amounts to not a whole lot of anything.
All right, we got to wrap it up there, Jack, but thanks very much for joining us.
Thank you.
Jack Manley is global market strategist at JP Morgan Asset Management.